Hi, welcome to another week of Proactive Wealth Strategies economic reviews. The bear market ended 1 year ago this week, finishing one of the fastest and most vicious bear markets of all time, one that led to a drawdown of 34%. Things have come full circle now as stocks has staged a furious rally and with new highs happening across the globe as the economy recovers at a record pace. We take a look back at what happened last March while also examining how previous bull markets did during the second year of their existence.
Well, time flies with market volatility, doesn't it?
Mm-hmm.
A look back. Although we aren't sure we want to, let's take a look back at the bear market and try to put in perspective just how historic and devastating it was for investors, while also pointing out some incredible positives. Here are 5 amazing stats to summarize the bear market and the bounce back.
Okay. Fastest bear market ever. Although it was only a 1 month long bear market, the S&P index fell 33.9% from February 19, 2020 peak until March 23, 2020 low. Along the way, it set record for the fastest 20% bear market ever, only 16 days topping the previous record from 1929. March 16, 2020, this day will go down in history as one of the worst days ever for stocks. The Dow Jones Industrial fell 12.9%, which was the fourth worst day in nearly 125-year history of the Dow. Only the crash in 1929, crash of 1987, and the day that trading started after being halted for months during World War I were worse than March 16, 2020.
The most volatile month ever. Huge swings, both up and down, were quite common in March of 2020. In fact, looking at the Dow, the average daily move up or down during March of last year was an astounding 5.3% per day. The previous record was 3.9% during March of 1929, again showing just how March of 2020 was like nothing we've ever seen before.
That's for sure. The bounce back was even more impressive. After falling nearly 34%, it took only 5 months for the S&P to recover its losses, the fastest bounce back ever for a 30% loss or greater. To put it in perspective, the S&P 500 also lost 34% in 1987, but that recovery took 20 months to get back to new highs.
Just a little bit longer. From red to green. At the lows in 2020, the S&P 500 was down 30.7% for the year, but when all was said and done, it closed up 16.3%. That was the first year in the history of stocks where they were down 30% at one point during the year and finished the year in the green.
Wild ride.
Very.
Now what? The bull turns too. Incredibly, the S&P 500 has increased more than 74.9% since the lows a year ago as of March 19, 2021, making it the best start to a bull market ever. After such a strong first year, where might this bull market go in its second year?
Figure 1 shows what happened during the first year and second year of bull markets that followed 30% or larger bear markets going back to World War II. Here are 3 takeaways to remember as the bull turns the calendar to year 2.
Since World War II, there have been 6 other bear market declines of at least 30%, and in every single case, the S&P 500 was up firmly the first year of a new bull market, with an average return of more than 40%. The good news is the gains continued in year 2, as stocks were also up the second year of a new bull market every single time, up a solid 16.9% on average. Only once after the 1987 crash did stocks gain more during year 2 than year 1.
The previous best start to a bull market ever was the 2009 bull market, which was up 68.6% after 1 year. Even after those historic 1-year gains, the S&P 500 managed to gain a respectable 15.9% during the second year. It wasn't an easy ride, however, as there was a 17.1% correction during the second year.
Pullbacks tend to happen during the second year of a new bull market, with an average year 2 pullback of 10.2%. Considering the current bull market reflected the best start to a bull market ever, this could open the door for an above-average pullback during year 2.
So even with all the current volatility, we are reiterating our bullish view. This bull market is off to an amazing start, but it is important to remember it is still young. While a pickup in volatility would be normal at this stage of a strong bull market, we think suitable investors may want to consider buying the dip. Vaccine distribution, fiscal and monetary stimulus, and a robust economic recovery all have our confidence high.
Agreed. COVID-19 still presents lingering near-term risk, with variants of the virus adding to the worry. Additional sharp and swift moves higher in interest rates could potentially cause valuations to contract meaningfully, though we see that as unlikely. We continue to expect a higher interest rate to fade as concern for the bull market, but it may take a bit more time to reach that point.
We continue to recommend an overweight to equities and underweight to fixed income stance relative to investors' targets as appropriate. We reiterate our S&P 500 index fair value target range of 4,050 to 4,100 at year-end 2021 based on a price to earnings or PE multiple near 21 and our 2022 earnings forecast $195. Again, should you have any questions, please feel free to contact your advisor here at Proactive Wealth Strategies. Have a great day and a good weekend.